A very good morning to all of you students. Today we will be discussing about some of the balance topics on the topic of derivatives, valuation and analysis. So we'll start our discussion with specific topic of real options. So till now students, we have discussed about the financial options, meaning where the underlying was an equity share mostly, or in case of forwards or futures, we have also discussed that the underlying was even commodity or a index, right? But in case of a real option, the underlying is basically related to the capital budgeting, the long-term projects in which the decision generally is taken by the companies whether to invest now, whether to invest later on, or whether to abandon those projects. Okay. So wherever the underlying, so in case of real options, the underlying is basically the capital budgeting projects which have high project value, and there is some amount of estimation in the cash flows that is required. So just to introduce this real options, so first of all here the underlying is a long term project. Okay, so the underlying is the long term project, plus this have variability in cash inflows, cash outflows, time period for completion. So if you think through students, so all these capital budgeting projects are the one where we are standing today, and we have to estimate, let's say over a period of 15 years, if I do this investment, what will be my returns, what will be my cash flows, and hence I take the present value of those returns and cash flows. So the moment we kind of estimate those cash flows in future, then there are good amount of chances that the variations will be there. Variations means the actual will be very much different compared to what the estimation is. I hope you're getting my point. So hence, because of these variations, this arises, this leads to one of the risk. And come on students, already we have discussed that all the options, or let's say forwards, futures, all the derivatives are used to manage the risks, right? The risk of the price movements in the earlier sessions that we have discussed. Here the risk is the risk of outcome of that project, whether the project will be viable or not. So those risks need to be curbed, need to be treated for, and hence for treating these risks we make use of real options. Okay, so the real options are basically the ones which will help out in hedging these type of risks. Now let me give you an example. In this 15 years, let's say we invested 10 crore here. Okay, in the beginning. After investing 10 crore in the beginning, on the, let's say, 5th year, we come to know that now we will not be getting anything further from this project. But if we abandon this project now, there will be some sort of realization that can happen to us. So should we abandon this? There has to be a right, or there has to be an option with me. Or let's say second type of example, I am not investing it now, but I just want to see that if I invest after 5 years, after 5 years, then whether this investment will become viable. Because today the investment is not seen to be viable, because 0 to 5 year there are no big cash flows that I'm expecting. So if on fifth year I invest 10 crore rupees, whether this will be viable. So that means I am trying to take an option to invest, right? Take a right to invest. What was the call option, students? Right to buy. Here it's a right to invest, or it's a right to sell. So I'm just trying to correlate it so that it's easier. Call option and put option, right? These are the two things that we have studied. This is right to buy. This is right to sell. This was in relation to the financial options, right? Where the underlying was a financial security, let's say share. Here, it will be right to invest in the nature of call option, okay? It will be right to invest, wherein we are saying that the right to invest now or later should be there with the person who has purchased this real option. Similarly, from put angle, if you see you are already invested, but you feel that there is no future about this investment and hence you would want to sell this off. So right to disinvest, maybe we can say, or right to abandon, right to sell. So I'm saying right to disinvest, right? Wherein we are trying to disinvest the investments. Clear, students?
Yes, clear.
Perfect. So just now we studied that in case of real option, first of all, underlying is a long-term project, specifically capital budgeting projects. And as I explained that what is the need of this? The need of this is because there is good amount of variability in the estimations of the cash flows, whether it is an inflow or whether it is an outflow. Because of that, the organizations want some flexibility to take the decisions, whether now or afterwards. And hence the genesis of real options, which is trying to curb this risk, which is trying to protect against this risk by giving different options. Okay. So this is whole about it. Now, one more thing. Entire capital budgeting, students, is actually dependent on very important topic or very important concept, which is actually discounted cash flows, right? DCF method, discounted cash flow method, students. This is very important. Why? Because using discounted cash flow method, we will arrive at the plain vanilla capital budgeting decisions. And using the similar analysis again, we will also arrive at the real options, how we are going to deal with them. Okay. Now, let's also try to understand the comparison between the financial options and real options. Financial options and real options. Here, let's say what is the underlying. So the underlying are those which are normally traded in the market, which are financial securities. For example, shares, stocks, bonds, even commodity for that matter. Shares, stocks, bonds, or even commodity. Now, in the real options, what is the underlying, students? The underlying is the projects. But are they traded in the market? Are these projects traded in the market? The answer is no. However, these shares, stocks, bonds, and commodities are actually traded in the market. Traded in the market. The real options have projects that are not traded in the market. Projects that are not traded in the market. Clear, students? For the underlying, it is clear?
Yes, sir. Clear, sir.
Perfect. Then on payoffs. So payoffs in case of financial options is properly defined in an option, right? If you would have seen, the strike price is properly defined, students, and
Yes.
hence using the, sorry,
I said yes.
sorry, I couldn't understand. Can you please repeat?
Sir, in the financial option, the strike price is properly defined.
Correct. In case of options, it is properly defined. Now, since it is properly defined, the payoffs can also be properly calculated. Correct. It has very less amount of any estimation. However, in case of real options, since it involves bigger time period, huge investment amounts, and different variabilities in the cash flows, and hence the estimation from this project can be varied, and hence the payoff can also be varied. So this is what we are trying to say, that the payoff is generally fixed here, and here it is variable. So we are talking about the definition of the payoff, students. We are not talking about the amounts of payoffs. Okay, the definition of the payoffs is definitely fixed here, but here it can be variable as well. The exercise of the third part is now exercise period. Financial option, students, in all the questions that you have studied till now, you would have seen maximum it is 3 months, 9 months, 12 months in one of the question we have discussed, right? But not more than 3 months, but not more than 1 year, right? But in case of these options, real options, the exercise period can never be 1 year, right? It will always be more than 1 year, because these are big ticket projects that we are talking about, right? So exercise period is short, up to 1 year generally, and here it is long, greater than 1 year mostly. Okay. Okay. Then there is an interesting terminology about price and value, right? Although we have used these two terms interchangeably till now in all our discussions, but there is thin amount of difference between price and value. So value is something which is basically which drives your long-term decisions, right? Those are value. Price is something which is short-term, traded on a stock, traded quickly, right? Those are the pricing, that what pricing I will get, what is the price of this. Similarly, if I say that okay, I will do this project for 15 years, I will not say what is the price of the project, I will say that what value this project is driving for us. Correct. So hence we call this as difference in approach, right? Here the approach is, because it is short term, traded on a stock exchange, these can be priced. Financial options can be priced. However, the real options are always valued, right? That what is the value, what is your net cash flows, what is your cash inflow minus cash outflow. Correct. So these are the four differences between financial options and the real option, students. Underlying, payoffs, exercise period, and approach. I hope this makes the comparison between the financial options and the real options clear?
So here real implies real estate, basically. Or is it something?
Not really. If you see, the company can invest into a plant as well, plant and machinery as well, right? In the capital budgeting decisions, let's say you are trying to invest into a machinery, then also you evaluate those decisions, and those will form the underlying of real options. Okay, so it's not necessarily only real estate. It can be real estate plus it can be other things also.
Right.
Okay, perfect. So now let's come to the specifics of it. So till now we have discussed about the real options. Now let's say what is the meaning of long call. So students, there can be 4 different scenarios, right? Whenever we talk about options, long call, long put, short call, short put. So that means long call means we are purchasing the put option. We are purchasing the call option. Long put means we are purchasing the put option. Short call means we are selling the call option. And short put means that we are selling the put option, right? This is what we have discussed in detail very much till now in the previous sessions. Now, in the context of real options, what would be the long call means? In the context of real options, the long call means that there is a right to invest, right to enter into the project. See, right to buy means what? That your right to invest into that security as per the financial option. In case of real option, there is a right to invest at some future date at a certain price. Okay. So long call means that you have a right to invest at future date, students. Okay. So in case of a call option, what was happening? We have a right to buy on a future date. Here we have right to invest on a future date. Simple. And investment will be with the objective of what? Maybe we can enter into a business, to enter into a business. That can be one of the objectives. The second objective will be what? To expand the business, right? Why will you invest? Either you will enter into a new business or you will expand your existing business. So to expand a business. Okay, so this is what the long call means. This is first case. Second case, long put option. Long put will mean that there is a, so what is the general meaning of purchasing a put option? That is purchasing a right to sell. Here also we are purchasing the right to sell at some future date at certain price. So here also in long call also right to invest at a future date at certain price. So this should be fixed. Similarly here long put will mean right to sell at some future date at certain price. Right to sell at some future date at a certain price. This is for the put option, right? Now here the project will in the context of real option, it will mean that we are already holding the project and we want to sell this project, right? Even it will also include right to abandon. Abandon means just leave it as is without any further things. Just leave it as is. Right to abandon at some future date at zero or certain price. At zero or at certain price. Clear? So this will mean that we are abandoning with none of the realizations, students. Okay. Then the third one is the short call. That means we are selling the right to buy or selling the right to invest. So this is, we are promising to sell if the counterparty wants to buy. So it is simply that we are mandating ourselves that we will be selling it to you or we will asking you to invest in this particular case. Okay. So from the context of real options, this is a commitment to disinvest. Right? So think it from the point of view of the option writer. So the option writer, in case of a call option, will have to sell. The moment they will have to sell, that means from the options, from the real option perspective, they will have to disinvest. So a commitment to disinvest upon the action of counter party to the call option. Clear? Then we have last one is short put. So in case of a short put, the promise is to invest if the counterparty asks us to do so, right? Because we will be giving them again the commitment that we will be investing it in case we are required to do so. Clear, students? A commitment to invest upon the action of counterparty to the put option. Simple. This is what the short put party will do. So let's say there is a call option holder, option writer. Okay. So in case of call option holder, what will happen? There is a right to invest at future date. Correct? Similarly, here the option writer will have a commitment to disinvest. Can you see the differences, right? Commitment to disinvest. Clear? From put option perspective, again on future date, the option holder will have a right to disinvest. And here the option writer, in case of a put option, will have a commitment to invest. Clear, students? I hope the discussion is clear, even with respect to who is doing what in terms of the parties.
Yes.
Perfect. Now, let's come to their valuations, or let's say the analysis part that we are supposed to do. So, from valuations perspective, we have already discussed about the binomial model. We have also discussed about the risk neutral method. We have also discussed about the Black-Scholes model. We have discussed about these three things, right? Binomial model, we discussed about the tree. Risk neutral method, we discussed about the probabilities. And Black-Scholes model, we discussed about the formula wherein we make use of the normal distribution table D1, D2, and the spot price and the strike price. Using that, we do the Black-Scholes model valuation, right? So we will make use of these three methods in our discussions or in our valuations of the real option, students. Okay. Now let's start with the first one. Or let's say, let's do one thing. Let's do basis the categories, right? So the type of real option, students. The first one is actually the growth option. Now, the growth option, students, is basically that you don't find to invest today lucrative because the project is not giving you the required NPV, the net present value. But still, you may want to invest because of the future potential in that project. Okay. And since there is a future potential in that project, you are really investing in the project, not because of the current situation, but maybe because of some future events that will lead to good amount of growth for your business. These are called as growth options. And in this, you are very clear that you will enter into the project at what specific date. So that's why it is called as European call option. These are also called as European call option because you are trying to enter into that project at a specific point in time. Okay. So this is basically with regard to the R&D activities, right? In case we want to set up R&D activities or some of the heavy expenditure on advertisement, if let's say we are trying to expand into some of the foreign markets to expand into the business, so these things will lead to future growths, correct? And hence these are called as European call options. Okay. Now let's understand this better through this question. Okay, students. So this question is on growth options from the real options topic. ABC Limited is a pharmaceutical company possessing a patent of drug called Adrex, a medicine for AIDS patient. Okay, being an approach drug, ABC Limited holds the right of production of the drugs and its marketing. So students, if you see, this patent is giving them two exclusive rights. One, production of drugs. Second, marketing of drugs. The period of patent is 15 years. Now patent have a time limit, right? They are not for unlimited time. So there, in this case, the patent's time period is 15 years, after which any other pharmaceutical company produce the drug with same formula. Okay. It is estimated that the company shall require to incur $12.5 million for the development and market of the drug. So this is the initial, or let's say not initial, but these are the amounts that the company will be required to pay, required to invest. As per a survey conducted, the expected present value of cash flows from the sale of drug during the period of 15 years shall be 16.7 million. So we are first of all talking about a Adrex drug. Okay. Time period 15 years. Cash outflow $12.5 million. Cash inflow will be how much through the sale of these drugs? 16.7 million. Cash flows from the previous similar type of drugs have exhibited a variance. Students, please note, this is what we are calling as variance. What is variance? %26.8% is what it is given. But what is the meaning of variance? Variance will give you that how much your cash flows are different compared to your, how much your estimated cash flows are different to your mean, or let's say the expected cash flow. Correct? So in statistical terms, this is standard deviation square. This is called as variance.
Sir, which means that from 16.7 million, it can be positive 26.8 or negative 26.8.
Correct. That is true. So it can be positive or negative, but not 26.8. It should be 26.8 square root. Correct? Because
Square root.
yes, because this is variance and you do mean plus minus standard deviation.
Yeah,
So if you
coefficient
want
of variation, we have to find it.
correct. So standard deviation will be under root of 26.8. Clear. Very good. So this is the right understanding. Okay. So the variation. So basically, the entire genesis of this topic is because we have a risk, and hence we have to do some treatment for that risk. And what is the treatment for that risk? That is the real option. Now, real option will take into account these into their valuation, right? The valued aspect that we've discussed in their respective valuation, these things will be taken up. That what is the variance, what is the cash inflow, what is the cash outflow, right? What is the period, and what is the rate of return. Similarly, we come to here. The cash flow from the previous similar type of drug have exhibited a variance of this of the present value of cash flows. Okay, it is the current yield on treasury bonds of similar duration is 15 years is 7.8% students. Okay, so 7.8% is the risk-free rate of return in case we want to use it. Determine the value of the patent. Now they are saying you need to determine the value of the patent, and they have given us some natural log details, some e raised to the power something something details. Okay, now it's symbol to the valuation of a stock option, but here the introduction of the drug Edrix, right? In case if there is a delay in this, then it will cause a cash flow hit. Correct? It will cause a cash flow hit. So if in, let's say, in 15 years we are not able to do this, but let's say if it gets delayed by 1 year, then what will be the pricing of, or let's say what will be the valuation of Edrex is what we are trying to tackle here. But the solution is very simple, students. Again, since we have given volatility, see, standard deviation is what? Volatility, right? Tell me, in these three methods, where do we use volatility? A, B or C? Come on, students, tell me, where do you use volatility? In Black-Scholes model, risk neutral method, or binomial model? Where do you use volatility, students?
Black-Scholes model.
Correct. It is used in Black-Scholes model, and hence we have been given in the present case volatility. We will put down these values in Black-Scholes model and arrive at the same. So let's first try to understand the formula of Black-Scholes model. The call option is equal to spot price multiplied by E minus D into F. There is small change here. Okay. This is then multiplied by N D1 minus E, which is the exercise price, and then E raised to the power minus RT, and then multiplied by ND2. So somewhat similar, students. ND1 and ND2 is somewhat similar, and the spot price and exercise price is also similar. Now the only difference is this extra element that has got added. So this is to account for the delay in the project. So let's see what value means what. So here D1 is equal to natural log of S by E plus R minus D, okay, plus volatility squared divided by 2 multiplied by time period. This is similar, only thing is minus D is getting introduced here. That's all, divided by volatility under root T. Okay, and D2 is equal to D1 minus volatility under root T. D1 is equal to, now we can put the formulas, related values in this. Okay, before that, let us define all these different variables. Okay, so now students, S, which is actually the spot price, is equated to the present value of the cash inflows, which is $16.7 million. E, which is exercise price, is actually the cost of development of the formula, students. Which is equal to $12.5 million. Variance of cash flow is directly given to us, which is 26.8%. The risk free rate of return is given as 7.8%, which is R. D, which is expected cost of delay, is equal to 1 by 15, which is equal to 6.67%, or 0.667, students. Clear? Now we can just simply put these different variables into the formula. Let's start with D1 and D2 first. Then we will calculate the natural distribution value, and then we can put the respective values in the formula simply. D1, students, is actually given by natural log of 16.7 divided by 12.5, correct? Plus the risk-free rate of return is 7.8%, which is then become 0.078 minus 0.0667. This is the D part, right? Which is the delayed part. Then plus V square divided by 2. So which is effectively already given as 0.268, which is 26.8%, right? 0.268 multiplied by 15. Time period is 15. And this whole divided by under root 0.268. Why I'm doing under root here? Because 26.8 is already at the square, right? So we'll have to take the under root and then under root 15 because this has to be under root t. Clear? Now d1 is equal to the natural log of 16 by 7 divided by 12.5. So which is this 1.336 is given as 0.2897 students. Zero point 2897 plus we solve this becomes 0.1453 into 15 divided by 0.5177 multiplied by 3.8730. Clear, students?
Yes, sir.
Then d1 becomes 0.2897 plus 2.1795. If we solve this, again whole divided by, if we multiply this, it becomes 2.005. And then again d1 is equal to 1.2315. So we'll have to just total this above. So from a step-by-step calculation, if we did 2.4692 divided by 2.005, and then the d1 will become 1.2315. d2 will become 1.2315 minus 2.005. d2 will be minus 0.7735. So n d1 n d2 students. Now nd1 and nd2 students we have discussed in detail. This is the normal distribution value of d1 and d2, right? So which is d1 is what? 1.2315 and similarly d2 is minus 0.7735. So this we will just refer it from our normal distribution table to arrive at the value, students, right? So as you would remember, we will always take area from left to Z score, correct? This is what we have agreed and discussed, students, right? So area, and this will be the cumulative area, correct? So ND1 becomes 0.8910 and this one becomes 0.2196, students. ND2 becomes 0.2196. and hence the value of patent is now determined as 16.7 into e raised to the power minus d into t, right? So which is minus 0.0667 into 15 multiplied by 0.8910 minus 12.5 into e raised to the power minus, which is r, right? So 0.078 again multiplied by 15, this whole multiplied by nd2 value, which was 0.2196, 0.2196. So students, this is n d1 value, this is n d2 value, this is spot price, this is exercise price, and then this is something that is there, and this is the present value factor, right? And as we discussed that this is for the delay, that if it gets delayed by 1 year, then what will be the outcome? Okay, and hence it becomes 16.7 multiplied by 0.3677 multiplied by 0.8910 minus 12.5 multiplied by 0.3104 multiplied by 0.2196. So this actually becomes 5.471 minus 0.852, which is equal to 4.619. Thus, the value of patents is $4.619 million. Clear, students? So, just to summarize on the growth option, students. Okay. So growth options are called as European call option. Reason being that herein we have a choice. Herein we have a right. We want to basically create a right to invest into the project, given the fact that today the project might not seem lucrative, but from a growth potential aspect, this can come out to be a very good venture. And this specific question we have discussed on the Black-Scholes model application within this growth options, wherein the use of the projected cash flows has been used as the spot and the exercise price along with the volatility and 1 year delay, which is D. Okay. So this is the first part of real option, students. The first type of real option, which is the growth options. Now let's move to the second type of real options, which is abandonment options. Right, students? So the abandonment options is basically so abandonment option, students, is basically the put option, right? Because in this case, we want to exit from that investment. And the way it can happen is through either abandonment by realizing whatever we have or by avoiding the huge losses. Now, students, in your capital budgeting, you would have already studied that these decisions are irrevocable, irreversible, wherein if you have committed your funds to the capital budgeting project once, it is very difficult to take a decision after 1 year that you are not going to continue with the project, because you have committed huge amount of funds, and hence if you exit out from that commitment, you will incur huge losses, because one, either you would have already spent good amount of time, good amount of money, or second, you would be contractually liable to pay those monies in future as well. That is called as capital commitment. However, due to some changes in the economic conditions, let's say you have launched a project 5 years back, and that project initially was 20 years. Now, after 5 years, because of certain changes, let's say in the government policies, the project has become less lucrative, and there is a decision that you need to come out of this project. There is no need to further take up this project. But the moment we do that, we just need to first estimate that what is going to be the likely impact on the cash flows. Is the company going to suffer huge amount of losses because of this decision, or if this is a cost neutral thing wherein there is no impact to the exit decision taken by the company? So this is first needs to be analyzed. So this option is relevant specifically in those cases where your exit amount related penalty is very low, or it is negligible, so that after you exit, you don't incur huge amount of losses. Okay. And this is called as a put option, correct? The growth option was called as European call option. But this abandonment option, since it has to be done basis a trigger which is beyond your control, and hence this is called as American put option, because there is a right to disinvest up to a certain time period. Okay. So this is called as American put option. And this will be exercised if the current value derived from the project assets to be exercised if current value derived from project assets is greater than the present value of continuing for one or more period, students. Clear? So in this case, it has to be analyzed with what you have in hand versus what you will be able to realize. Okay? For this, let's come to question number 2. This is actually from the study material illustration number 5. So illustration 4, 5 and 6. Basically, this is what we intend to cover. So IPL already in production of fertilizer is considering a proposal of building a new plant to produce pesticides. Suppose the present value of proposal is 100 crores without abandonment options. So this is a plain vanilla present value. However, if market conditions for pesticides turns out to be favorable to the however, if the market conditions for pesticides turns out to be favorable, the present value of proposal shall increase by 30%. So they are saying, in case, let's say there are some market conditions for the pesticides, if they turn out good, that means the sale will be good, the demand will be good, and hence the present value will also increase by 30%. On the other hand, market conditions remain sluggish. So there are two possibilities, right? So question is trying to tell you that either the prices will go up because of some economic conditions, because of some market conditions. At the same time, there is a second possibility that the prices might go down as well. This is because of the sluggish conditions. The present value of proposal shall be reduced by 40%. In this case, it will be reduced by 40%. In case company is not interested in continuation of the project, it can be disposed of for rupees 80 crores. So this is also rupees, this is also rupees. So they are saying that in case it is decided not to continue, it can be immediately disposed of for rupees 80 crore. If the risk-free rate of interest is 8%, then what will be the value of the abandonment option? They have given us the risk-free rate as well of 8%. Now students, tell me, using which of these two methods? So I will not put risk neutral method. Risk neutral method is a way to calculate probabilities. But using binomial model or using Black-Scholes model, which formula will you use here? Or let's say which approach we should use here? Sluggish means
Binomial model, sir.
Binomial.
very good.
Because
Binomial.
we have two probabilities, two
Yes,
conditions.
two conditions. Either the prices will go up or the prices will go down. Very good, students. Sluggish means so Saminathan is asking what is sluggish. Sluggish means slower, slower down, right, at a slower pace. When the economy is on a lower growth, it is called as sluggish, or there is no growth. Okay. So we will not be using Black-Scholes, we will be using binomial model, because this have clearly specified that there are two possibilities, either it will go up or it will go down, right? Where were we? Yeah. So currently it is 100 crore. Now it can move up to 130 crores. or it can move down by 40%, which is actually 60 crores. Correct? So these are the two different options that are available. Now somebody want to ask us that what is the ratio of higher price, which is this much, ratio of lower price, which is this much. Correct? Because this is what we also tend to use. Now student, comes the very basic question. 130 or 60. These are the two different possibilities if we continue with the project. Continue. Here abandon. In case I want to abandon here, I can abandon at 80. In case I want to abandon here, I can abandon at 80 again. Right? Because abandon value that I'm going to realize by sale of these assets is actually same. Sorry, the writing. Just give me a second. So what I'm trying to say is that the abandonment value is going to be similar, which is 80 and 80 in both the cases. Okay. Now with this information, students, you tell me that under these two situations, what should we do? In the first situation, if the market price turns out, if the market conditions turns out to be good, and the price itself of the project
30 crores.
improves, then what will you do? Will you abandon the project or will you continue with the project?
We will continue the
Continue.
project. In the case it's
Very good.
up or down.
Very good, because you are able to realize 130 crores, which is higher than what you have estimated of 100 crores. And even on that particular date, it is even higher with what you have estimated to abandon at 80 crore. Okay. But in case of situation 2, where there is a sluggish economy, in this case, if you continue the project, you will realize 60 crore. If you abandon the project, you will realize 80 crore. So what you will do in situation 2?
Abandon.
Abandoning situation 2 because we will get off.
Yeah,
We will get 80 and we will have a value of only 60 crore.
correct. So in the second case, you will exercise your abandonment option. So I'm just linking it with your financial options, right? So this is a right, and hence you will exercise the abandonment option. So just imagine the students that 80 rupees is my strike price. We are talking about put option. So in case of a put option, when it becomes in the money, when the price is less than 80 crores, right? And when it will become out of the money, if the price moves more than 80 crores. Clear, students? So more than 80 crores,
Yes.
the moment price goes up, it will become out of the money. Now, in our case, 60 and 130. Now, can you tell me at 60, the payoffs will be what? The payoffs will be 20 crore under the option. Okay, let's not discuss about the gross cash flows, because here we are talking about now the options, students, right? So here, under this option, 20 crore is what we are able to realize as a payoff. However, when the price moves to 130, we can just go and execute our project. That's all. There is no need to abandon the project. And hence, if we are not abandoning, that means we are not exercising the right. If you are not exercising the right, that means the payoff will become what? Come on,
Zero.
student. Zero. Yes. The payoff will become zero. Clear? Here, the payoff will become 20. Clear? So now, if I just draw a binomial model tree, year 1, 130, and 60. These are the two different possibilities. Year 0, it was 100, right? Payoffs, this becomes 0, and it becomes 80 minus 60 as 20. Now, what is the next step, students? Again, I would want all of you to think and tell me. We have calculated the payoffs. Now, what is the next step? See, the ultimate objective is we have to calculate the value of this put option, right? The value of this abandonment option. So how we can calculate? By just valuing using a binomial model. Now, had this question been a financial options question, and we have already arrived at the payoffs. Now, what is the next step, students, that we have to do here? Come on, students. For binomial model, what is the next step that you do to arrive at the... Come on, what should be the next step in binomial model?
To find out the probabilities.
Yes, very good. We'll have to find the probabilities, because we need to know that what is the probability of price going up and the probability of price going down. That means we'll have to calculate the probability of high demand. Okay. Probability of high demand, which is P, using the risk neutral method, which is risk neutral method, students. We can use any method we want. The result will be similar. So this is going to be 8% is equal to probability of price going up, or which is probability of higher demand, we have already assumed to be P, multiplied by 30%. So 30% the prices will go up, right? Plus, if P is the probability of higher demand, 1 minus P becomes the probability of lower demand, multiplied by minus 40 percentage. Okay, so the weighted average of this will be 8%, correct? So 0.08 is equal to 0.30p plus, actually this will become minus 0.40 plus 0.40p. P is equal to 0.48 divided by 0.70, which is equal to 0.686. So the probability of higher demand P will become what? 0.686, and the probability of lower demand 1 minus P will become what? 1 minus 0.686, which is effectively equal to
0.314.
0.314, right? Clear? Now we can calculate the value of abandonment option. First we'll calculate, and as I said that always we have to move from right towards left in the calculation for any binomial model. Always calculate the value at the farthest time and then come to today's time, okay, by taking the present values. So here the value of abandonment option will be as follows. Expected payoff at year 1, which is equal to P into 0 plus 1 minus P into 20. Correct? Why? Because this is a 0 payout at 130 and this is a 20 payout at 60 crores. So this will become 0.686 into 0. Yes, is there some question, students? Okay. So 0.686 into 0 plus 1 minus P is 0.314 into 20. So this overall becomes 0 and this becomes 6.28. So finally it becomes 6.28 crores. So till now we have calculated the value of abandonment option after 1 year. Value of abandonment option after 1 year is actually 6.28 crores. Since expected payoff after 1 year is this, now the present value since expected payoff at year 1 is 6.28 crores, present value of expected payoff will be 6.28 crores divided by 1.08, 5.81 crores. Since the risk-free rate is 8%, students, we have calculated the present value of this as on today, which comes out to be 5.81 crores. I hope this is clear, students, to all of you. Here, yeah. Perfect. 5.815, Saminathan, your answer is also correct. Okay. Now let's come to the last part of the real options, or the third part of the real option, which is the timing options. So in case of timing option, students, now here the decision that is involved is whether to invest now or delay the decision to invest. Okay. So in this we compare two different situations, whether there is a merit to invest now or whether there is a merit to invest later. Now, since this is dependent on not at a specific point of time but up to a specified period, hence it is an American option, and this is a decision on investing, not on disinvesting, hence it is a call option. So it is American call option. Okay, so this is basically just on this ground only, whether to do the investment now or later on. Let's try to understand this with the help of this question, which is illustration 6 from the study material. Suppose MIS Limited is considering installation of, just a second, installation of solar electricity generating plant for light the staff quarters. The plant shall cost rupees 2.5 crores and shall lead to savings in electricity expenses at the current tariff of rupees 21 lakhs per year forever. So students, there is no time limit for this savings that we are seeing. We are saying forever it will save 21 lakhs. However, with change in government in state, the rate of electricity is also subject to change, which is okay. Accordingly, the saving in electricity can be of rupees 12 lakhs or rupees 35 lakhs per year and forever. Now, students, again, they have given you two different possibilities, the price going up or the price going down. Assuming WACC of MIS Limited is 10%, so weighted average cost of capital is 10%, and the risk-free rate of return is 8%, decide whether MIS Limited should accept the project or wait and see. Simple, it is asking you to say, to analyze in such a manner that they should do the investment now or they should wait. So this we can compare only two ways, right? If we compare the NPV as on today, and if we compare the NPV after 1 year, right? Whichever situation is better, we can accordingly then guide. Okay. So the situation 1 is NPV as on today, students. Now, as on today, it's very easy. As on today, we have a possibility, we have a estimation certainty that 21 lakhs is the savings. So at cost of capital at the rate of 10%, the value of savings is equal to 21 lakhs divided by 10%, which is actually equal to 2.1 crores. What is the initial cash outflow, students? 2.5 crores. So 2.1 crore and 2.5 crore, there is a negative NPV here, right? 0.4 crore. Okay. Then the next part is, this is the NPV as on today, students. This is NPV is negative. NPV is negative. It does not worth to accept the project. Now NPV after 1 year. NPV after 1 year is, there are two different possible situations, right? So let's plot both of them. If the price of electricity increases, in such a case, what will happen? At cost of capital 10%, the value of savings will be, the value of savings forever will be 35 lakhs divided by 10%, which is equal to 3.50 crores, students. Okay. So the position of the NPV will be $3.50 crores minus 2.50 crores, which is actually 1 crore. Okay. And somebody might say that what is the rate of return? Right? 1 crore on 2.5 is how much? Rate of return is equal to 1 divided by 2.50, which is 0.40, which is actually 40% students. Okay. Then B part is if the price of electricity decreases, then at cost of capital 10%, the value of savings will be, now the 12 lakh is the reduced savings, divide by 10%, so this becomes 1.20 crores, right? And hence the NPV will become 2.5 crores minus 1.2 crores, which is negative of 1.30 crores, right? Rate of return is actually 1.2 divided by 2.5 minus 1, or effectively minus 1.3 divided by 2.5, which is equal to minus 52%. Clear? So this 2.5 crore can be shown as into two different cash flow streams. One is 3.5 crore with a NPV of 1 crore, right? And here 1.2 crore is the cash flow with a NPV of minus 1.3 crore. Okay. Now the next part is only the calculation of probability, students, right? Now let P be the probability for increase in prices. Okay, so this will be then given as P into 0.40 plus 1 minus P into minus 0.52, right, which is the proportion of prices going down, then 0.08, right? The weighted average will be 0.8. So 0.92p is equal to 0.60, and hence the p is equal to 0.652. So the expected payoff will be at a rate of 65.2% for 1 crore and the balance probability for minus 1.3 crore. So we can find out, hence expected payoff is equal to 0.652 multiplied by 1 crores plus 0. The balance probability, which is 0.348 multiplied by minus 1.30 crores. This is equal to 19.96. Sorry, this is in lakhs. No, this was in crore, but the overall amount will come into lakhs because there is a reduction of 1.3 crore for 34.8% probability, and hence the present value of payoff after 1 year is equal to 19.96 divided by 1.08, which is actually equal to 18.48 lakhs. Hence, it is advisable to wait and see as the NPV may turn out to be positive, because currently it's not positive, students, right? Currently it's not positive. It might turn out to be positive, and hence we are of the view that it should not be invested now, but it should be hold back and seen after 1 year, students. Okay. So this was all about the topic on real option, students. Okay. Now there are two quick topics, a very small touch upon on two different derivatives as well. One is electricity derivatives, and the second one is weather derivative, students. Okay, these are the two new things. So let's talk about weather derivatives first. So students, in case of weather derivatives, the underlying is basically the weather. Why? Because so if you see, some of the company's performance is dependent on how weather turns out to be, right? By weather, we not only mean the temperature, but even, let's say, the humidity, the rainfall, right? So all these are measured using specific measures of weather. Now, companies might want to protect their risk arising out of the adverse weather conditions, right? To do that, they will enter into a weather derivative in which the underlying will be a weather measure. Underlying will be weather, right? And these are mostly over the counter contracts, right? So this can be, let's say, a temperature. This can come out from a specific temperature, that if the temperature is this much, then the forwards or futures will be there, and similarly options are also there, using that as strike price of that specific temperature measure, right? Similarly, in case of a option buyer and option seller, there is a premium paid, right? For this also, the risk the person is undertaking, they will expect a premium to be paid, right? However, there are some issues in terms of the pricing that is involved. One, definitely the data, because the reliability of data is a very big challenge. Correct. Second is the forecasting of weather. So we all know the forecasting of weather can lead to different issues, right? If it is not predicted properly, it can lead to differences in the valuation. Then students, there is another concept. I hope this is clear, right? So this is a very limited, discussion on weather derivatives. Similarly, for electricity derivatives, electricity derivatives. Now, just before the last question, in the last question, we discussed about the electricity being one of the factor for price movements, right? As you are a consumer or a supplier of electricity, because the companies also generate and supply it to the government. Similarly, companies also purchase electricity from government. Now, these prices are actually different, and these are governed by some of the agreements. So, for example, purchase will be governed by the power purchase agreements, and similarly by the government. And similarly, the supply from the government will also be subject to the differences in rates. Now, the moment it is there, there is a price movement in electricity that is there. To hedge against those price movements, the concept of electricity derivatives is there. In this case, the electricity acts as an underlying for the derivatives, right? And the forwards, futures, and swaps are available for protecting against the adverse movements of derivatives. Now, electricity forward will typically mean that you are buying or selling fixed amount of electricity at a pre-specified price on a future date. Similarly, electricity futures are again standard contracts, right? Similarly, for selling or purchasing the quantity of electricity at a future date. And electricity swaps are basically we are swapping the fixed rate versus floating. So fixed electricity rates versus floating electricity rates. So in this case, what will happen? So I am exposed to the floating rates. I will swap it with a counterparty which will say that okay, whatever is the floating increase decrease that they will bear, and I will just pay the fixed amount of the rates. Okay. So these are the two brief things on electricity and weather derivative, students. So with this, students, our overall discussion on derivatives analysis and valuation, including the real option, comes to an end. I now request CA Ashish sir to help with the concluding remarks. Thank you, sir.
Thank you,
Thank you,
Devasar.
students.
1 second. Thank you, Devasar. Actually, your session was very good because this topic has been left over regarding the real option application of concepts of derivatives, especially options in the real. Actually, we also call it as a strategic decision because in fact, I remember one case when the Reliance. I think Reliance Industries Limited used this decision many times. This approach many times, like whenever they are opening any new, because they generally venture into a new strategic type of thing, like venturing into the oil or venturing into the retail business. So there this technique is applied very much because as you have clearly very, I think in the second or third question, sometime a option any decision, capital busting decision may have a negative NPV, okay,
Yes.
in isolation. But since if it has any option element within it, so then our NPV can come out to be positive.
Positive.
And of course, we have to we can accept the decision. So this element of option in any capital budgeting decision is the main basis of strategic decision as well, because
Right.
sometimes it gives us a growth opportunities, sometimes it gives an abandonment option, and especially in case of films. I will just only 1 minute I will take of you.
Sure,
Even
sir.
Devasa, you if you want to leave, you can leave, no problem.
Sure,
Okay.
sir. Sure, sir.
Okay.
Sure, sir.
Okay,
Yeah.
student. I just want to explain you, like in case of option films, especially in case of it normally happens in the Hollywood, where you will notice that there are some sequels are there. Okay, when sequels are there, why every movie have a sequels? Because you notice that generally villains are never die in the Hollywood movies because they always have some scope for sequel. Why they keep a sequel in their or why they keep a provision of sequel in their movies? Because they think like that if the movie is successful, then they will come out with some sequel. So this option element is there, and this option is element can be valued. Whereas in so if the if a film goes flop, say they stop making any sequel. I remember that in somewhere around in 1990s, there was one movie has come, Terminator. So after that, I think Terminator 2 has come. I think even Terminator 3 might have come, but I have seen up to 3 Terminator 2 as well. I remember it. So it is very important that you have to see that if option element in any capital busting decision, it is kind of a real option, and we have to value it separately so that our decision making is very strong. So with this, student, we come to the end of this chapter, very important chapter, derivative analysis and valuation. As I told you in the beginning of this chapter forms the basis of our another chapter like foreign exchange exposure risk management, where these techniques shall be applied of the basis and where the underline will be this. Okay, Samanathan, very good. You have seen the Terminator because there in the first movie, Arnold Schwarzenegger was a villain. In the second part, he was a hero. So it was a very good combination. Thank you. Very encouraging. So student, with this, yeah, with this we come to the end of the session, and we will start with that new topic, foreign exchange exposure risk management. Thank you very much. If you have a query, you can contact me on the telephone or you can send me the email. Till now, revise whatever discussed in the previous sessions. Okay, thank you for your patient listening as well. Thank you. Okay, thank you. Have a nice day. अशोक जी, हाँ जी, सेशन होगा।
सर
हाँ बोलो बोलो अजीत बोलो।
सर ओवर
हाँ ओवर,
ठीक है सर।
ठीक है।